Welcome to today's Explainer. Look, if you're a focused learner looking to finally take control of your financial future, you are in exactly the right place. Today, we're embarking on this really empowering journey to demystify one of the absolute best tools out there for building long-term wealth. And honestly, the best part, we're going to learn how to do it without all that usual anxiety, confusion, or, the overwhelming jargon that basically suffocates the financial world. We're breaking the whole shebang down, step by step.
So I really want you to think about this for a second. Do you want to grow your money, to see your hard-earned savings actually multiply over time, but completely avoid that constant nail-biting panic of trying to pick individual winning stocks? Yeah, me too. So many people just stay out of the market entirely, right? Because the idea of staring at ticker tapes and stressing over daily price swings is just, it's just way too much. But today, we're introducing the core solution to that exact problem.
Okay, let's dive into this. Here is our roadmap for today. We're going to cover decoding the mutual fund, how your money works, the power of diversification, mutual funds versus stocks, and finally, avoiding common investing mistakes.
All right, part 1, decoding the mutual fund. What exactly is this financial tool and why is it so absolutely crucial to your financial future?
Okay, so the literal game changer here. The most important word to remember is pooled. A mutual fund is basically an investment where your money isn't just flying solo. Instead, it's combined, or pooled, together with money from a ton of other investors into one single massive fund. And here's the real beauty of it. That massive pool is managed by a professional. This expert takes all that combined cash and invests it across assets like stocks, bonds, and other securities. The main takeaway? You do not have to research or buy individual investments yourself. You just own a small share of this fully formed, diversified portfolio. And the experts, they do all the heavy lifting for you.
And this brilliantly illustrates the whole concept. Think of this pool as a three-part synergy. You've got your slice, right? Your money. Then it joins up with a much larger slice, other investors' money. And together, they're guided by that third slice, which is the professional manager's strategy. So your relatively small individual contribution instantly gains the incredible buying power and the expert oversight of a multi-million-dollar fund. It's just a wildly efficient way to get access to a pro-level portfolio.
Moving right along to part 2, how your money works. Let's look at the actual mechanics, what actually happens behind the scenes once your cash enters that pool.
The journey of your invested dollar basically happens in 3 logical steps. Step 1, you and countless other investors pool your money together. Step 2, the fund manager takes that massive pool of capital and literally goes shopping, buying up a wide variety of investments based on whatever the fund's specific goals are. And then we hit step 3, which you absolutely need to understand. The value of that fund, and therefore the value of your share in it, is going to fluctuate. It's an active, living thing that is totally tied to the broader financial ecosystem.
And I really want to be upfront and direct about this next point. If the investments chosen by the manager increase in value or earn income, your investment grows. Obviously, that is the goal. However, if the market declines, your investment may lose value. That's just the undeniable reality of investing. There's no magical shield against market drops, guys. When the market goes down, the value of the assets in your fund goes down, and your personal balance is going to reflect that. Really grasping this reality, that's your very first step to becoming a resilient investor.
Okay, part 3. The power of diversification. This is exactly how you reduce your overall risk, and honestly, it's the primary reason these funds are so incredibly appealing. You know that old saying, don't put all your eggs in one basket? Well, this is the classic basket metaphor brought to life in finance. By spreading your investment across a bunch of different assets, we're talking dozens or even hundreds of different companies or bonds at the exact same time, you inherently reduce your risk. If one company in your basket has a terrible year, hey, it's okay, because the other 99 companies in there might be having an amazing year. The mutual fund is basically your ultimate prepackaged diversified basket.
Now, what's really interesting about this slide is how highly targeted these benefits actually are. For instance, having professional management is just perfect for beginners who, let's face it, do not have the time or the expertise to sit around analyzing corporate earnings reports all day. And thanks to a really low barrier to entry, you don't need to be a millionaire to get started. A lot of mutual funds let you begin building wealth with a relatively small amount of money, which makes it super accessible for new investors who just want to get their feet wet. Let's jump right into part 4, mutual funds versus stocks. Let's compare the alternatives and really put our diversified basket to the test. So, here is the fundamental trade-off in investing. Buying a single stock means you are tying your money and your hopes to the fate of one single company. Now, sure, if that company skyrockets, stocks can offer higher returns.
But man, that comes with significantly higher risk. If that company fails, your investment fails. End of story. A mutual fund, on the other hand, invests in many companies or assets at the exact same time. It spreads your investment out, which generally brings your overall risk way, way down.
So the crucial point is that it all boils down to a single number, 1. 1 is the number of companies you are relying on when you buy a single individual stock. 1 CEO, 1 product line, 1 single earnings report. If anything goes sideways with that one entity, your entire investment takes the hit. That intense, concentrated risk is exactly why spreading your money out through a mutual fund is so vital for your long-term stability.
Finally, Part 5, avoiding common investing mistakes. Understanding the mechanics is really only half the battle. So let's protect your hard-earned wealth by exploring some common behavioral traps. These are the traps that catch so many beginners. Investing in a fund without actually understanding what it holds. Selling your shares out of pure fear the second the market has a downturn, which literally just locks in your losses. Ignoring the fees the fund charges, which will absolutely eat into your wealth over time. Failing to diversify properly. And perhaps the absolute most dangerous of all, expecting quick profits. Mutual funds are not get-rich-quick schemes, guys. Acting on fear or impatience will severely damage your financial future.
Let's move to and see how this builds into the ultimate behavioral solution. As the old saying goes, successful mutual fund investing usually requires patience, regular investing, and a long-term perspective. That right there, that's the secret sauce. It's not about timing the market, it is about time in the market. Maintaining a steadfast, patient mindset and just contributing regularly is exactly how everyday people build truly extraordinary wealth over decades.
And that leaves us with one final provocative question for you to really reflect on today. Are you ready to trade the high-anxiety stress of the financial sprint, picking single stocks and desperately chasing quick profits, for the enduring, diversified success of the long-term marathon? Mutual funds give you the vehicle, they give you the professional driver, and the map. Honestly, all you have to do is get in, buckle up, and have the patience to enjoy the ride. Thanks so much for joining me for this explainer, and I really hope this gives you the confidence to start building your own path to wealth.